Hi there, it's Mike again, and in this video we're going to take a look at dividend income. So let's assume we have someone who's received $15,000 in eligible dividends and that these dividends will be taxed at her marginal rate of 29%. We would assume that she's got other income that pushes these dividends into that bracket. So what we want to do is determine the federal tax that would be payable on the dividends and what she would actually retain in cash after paying her taxes. So a quick recap of the CRA guidelines for taxable dividends is that dividends are included in your total taxable income. They're taxed in the same method as all other income using the marginal rates. And in the case of dividends, we gross them up. So for 2015, the gross up on eligible dividends is 38%. On non-eligible, it's 18%. And a federal tax credit is then applied to the dividend tax payable, and that's calculated on your Schedule 1. So the dividend tax credit rates for 2015 are 15.02% for eligible and 11.01% for non-eligible. So let's look at the income that this person earned. They received $15,000 of dividends, and we grossed those up 38%, giving us a total taxable dividend of $20,700. Now, where would this be reported on your T1 General? Well, let's have a quick look. So on your T1 General, on the second page, we report all of our income sources. So in the case of taxable dividends, they're reported on line 120. So we reported our $20,700 on our T1 General. And if we were to calculate the tax on those, we would use the marginal rate of 29%, and we would deduct from that a dividend tax credit of 15.0198. Now, where would we do those calculations? That would be on the Schedule 1. So here we are on the Schedule 1, and we would include the taxable dividends in the calculation, the marginal tax calculation, and in this case we would use 29%. And we would take a federal dividend tax credit on line 425 of 15.02% of the taxable dividends. So in this example, we can see that we grossed up our dividends by 38% and reported $20,700 of dividend income. We calculated 29% of taxes owing for an amount of $6,003, and we would have reported a dividend tax credit of $3,109, meaning that we would have had to pay taxes of $2,894. So on $15,000 of dividends, we would have actually retained $12,106. So the actual tax rate on those dividends for this individual was 19.29%. So a quick recap for eligible dividends is dividends are grossed up by 38% in the case of the year 2015. Those rates do change every year, or can change every year. And that grossed up amount is included in dividend income on line 120 of the T1 General. And the calculation of the tax owing, as well as the dividend tax credit, are calculated on the Schedule 1, and the net tax owing is carried over to our T1 General. So I hope this video on dividends has been helpful.